Well, I'm sorry to say, viewer, every story eventually comes to an end. And in this case, it's my 6-year-long investment into Costco. As you know, I made numerous videos about Costco, going way back to 2019. It was one of my very first holdings ever. I invested in Costco originally not because of the fundamentals. In fact, before I even had Qualtrim built, before I had a full understanding of the financials, I started to build a position, a small one in Costco, based purely off of the ethics and business model of the company. I thought it was so incredibly consistent, so reliable, such an incredibly good retailer that I wanted to own the stock. But then as time went on, I continued to get better at doing analysis. I started looking at the fundamentals, the growth rates, the profitability. This increased my confidence in Costco as a long-term compounding machine, a company that would be financially prosperous for years to come. These type of financials with this type of business model and leadership is a combination that I've always really liked. And that was the thesis for me continuing my investment in the company. But as we know, Costco recently got a new CEO. Late last year, Costco announced that their long-standing CEO, Craig, would be stepping down, and the new CEO, Ron, would be taking place. Now, I felt comfortable with Ron being the CEO because he's been with the company for a long period of time. So I thought he would understand the culture and how Costco works. But it seems like Ron has very different ideas of how the company should function. One of the first actions he took as the CEO of Costco was a definite red flag. He raised the price of the hot dog combo. From the Wall Street Journal, quote, "It's time to exercise our hot dog pricing power." Costco CEO. Costco's new CEO raises the price of the hot dog combo for the first time since 1985. For decades, the hot dog combo has stayed at $1.50, and now he's raised it to $3. Now, I understand he wants to drive revenue growth, he wants to hit those quarterly metrics, but it seems like raising the price of the hot dog combo is not the way to accomplish that. That is tradition. That is the culture of the company. There's another article as recent as last month saying that Costco stock is up after removing return policy. Removing return policy? Quote, "All sales are final." That doesn't seem like the Costco I know. The Costco I know is one that has a great return policy. You're going to return things anytime you want. That's taking care of your members. But this new CEO seems like he is far more focused on profits than he is the long-term health of the company. This was the second red flag when looking at Costco. Now again, I know that new CEOs want to come in and run things their way, but these seem like pretty substantial changes, at least huge changes to the culture of the company. So I'm scratching my head over all of that recent news, and then I finally get to this article, which was the final red flag for me. What Costco's $2 billion investment into AI firm Anthropic could mean for investors. I don't know. Looking at this, Costco's now investing into Anthropic, buying AI firms, seems a little odd. So after all these red flags, I thought it was time to finally cut ties with Costco. It's been a long, fun journey. It's been a very profitable one investing in this company, but it's now time to move on. Okay. Now, obviously I'm joking, folks. Costco is not raising the price of their hot dog. They're still accepting returns and they're not investing into Anthropic. And I'm not selling my Costco shares, for better or worse. But as of right now, I continue to hang on to my Costco shares. Now, there is one company that I did sell in my portfolio. And that is not an April 1st April Fool's joke. This morning, I sold out of one position in my portfolio and I bought another. This was a $21,000 trade, and I'll be showing you what this trade was and why I did it in this episode. So all joking aside, we actually have a big trade to get into today. So let's go ahead and jump in. I'll first start off by just outlining the company that I sold and the company that I purchased. I sold entirely out of this position, and it's one that I've talked about selling for a couple of months now. And it's Union Pacific. I finally decided to sell out of Union Pacific, one of my two railroad companies. Now I'm keeping Canadian Pacific, so I haven't sold a single share in Canadian Pacific, but I sold 100% of my position in Union Pacific, and this was a $21,000 position. I took a screenshot of this position before I sold it so you can see what it looked like. It was around a $21,000 holding, and it was around $4,000 in the green. So I was up roughly 23% on it, and that was over 1 year of holding the company. So overall, the returns on it were, I would say, conservative. I got positive returns. I made $4,000. So this was not selling at a loss or selling during weakness. This was a holding I made money on, which I always feel good about. It was another win in the portfolio. So even though this position has been decent and I was able to get some gains out of it, over the past couple of months, I've continually felt like there's better opportunities for me to invest in. Companies that will offer more attractive returns. One of my biggest concerns with Union Pacific was the overall growth profile of the company. In my investing philosophy PDF, I outline what I'm looking for in a company, and I try to find the ones that match to this as close as possible. Now, this is available for free. You can download it in the linked pinned comment below, but it goes over compounding machines and the type of different metrics I'm looking for. One metric of a compounding machine is they typically have organically growing top-line revenue. Revenue that grows above 7%, sometimes 15% or more. But I like to have top-line organic revenue growth. Organic revenue growth means that they grow without acquisition. They can have acquisitions as well, but it's better if they grow quickly without the need for acquisition. And I outline, as an example of a compounding machine, Costco. Costco doesn't do many acquisitions. In fact, they do very little, and they grow their top line continually every single year. You can see the substantial growth of Costco's top line compared to AT&T's, which is lumpy and mostly driven by large, expensive, and value-destructive acquisitions. So what I'm looking for are companies that have that nice top-line Costco-like growth. And I'll say that almost every company in my portfolio has organic top-line growth. Every single one of them, except for one, which was Union Pacific. Union Pacific was the only company in my portfolio that had almost no, in fact, basically no top-line growth. When I look at the revenue chart here, we can bring it up over the past 10 years. If we zoom in, this is what the past decade looks like. In 2014, they had $24 billion of revenue. In 2023, they had $24 billion in revenue. They literally had identical revenue in 2014 that they do to current day. And that is the problem with Union Pacific in terms of the overall growth profile. With this company, you're not even getting inflation-adjusted growth, you're just not getting any growth at all, which means that inflation-adjusted, Union Pacific has actually lost revenue over the past decade. The company's actually shrinking in total revenue. And as I looked at this, I realized there's other parts to this investment. It is a margin expansion story, so even if their top line isn't growing, they can continue to get gains through margin expansion. But that's something that proves really difficult to do. It's easier for a company to have operating leverage, which means they grow their revenue while keeping their expenses the same. What Union Pacific is trying to do is far more difficult, expanding margins without growing revenue. Another issue with Union Pacific that I've been looking over, and it's just something that bothers me again, is the free cash flow growth of the company and the main drivers of this free cash flow growth over the past decade. If we look at the free cash flow per share, it's actually been growing a lot faster. This is an attractive free cash flow growth profile. Part of the way that Union Pacific drove this growth over the past decade with no additional revenue was through share buybacks. You can see over the past decade that they bought back a lot of shares, going from 900 million outstanding to 600 million. So they bought back roughly 40% of their market cap over the past 9 years. Very fast buyback program. But the way that they're funding this, partially, is with a lot of debt. They've also taken out a lot of debt over the past decade. For example, we can look at Union Pacific's debt from 1966 to around 2012, and it's flat for this entire time period, for around 20 years. And then for 10 years, from 2014 to 2022, their debt tripled from around $10 billion to $30 billion. Now that's a tripling of total long-term debt while the revenue stayed flat, which means the company's gaining more and more leverage over time. This is not a sustainable path. Union Pacific cannot continue to raise their outstanding debt over time, especially with interest rates going up. So they had to stop their debt and in fact even trim it down a little bit last year. Without issuing more debt to get more capital to buy back shares, they're not going to be able to buy back shares as quickly. If they're not able to buy back shares as quickly, they're not able to grow their free cash flow per share as quickly. And if they're not able to grow their free cash flow per share quite as fast as historical, the returns may not be as good as they historically were. So my concern with Union Pacific is that it won't have the same amount of growth that it has had historically, and it may give conservative, if not underwhelming returns. Now, the company is a super wide moat company. It's critical to US infrastructure. I think the company is much, much stronger than the majority of companies in the market. So I'm not trying to bash Union Pacific or say it's a bad company, but in my portfolio, I'm looking for strong growth profiles, companies that can grow free cash flow per share above 15% per year. When I feel that a company may have subpar growth or it may struggle to grow in the future, that's one that I'd rather swap out for some company on my watch list. I have a watch list full of compounding machines, incredibly strong companies that I feel very, very bullish about. So I decided to make the switch. I decided to sell out of Union Pacific and buy a brand new position in my portfolio with the proceeds. With the $21,000 proceeds from the sale of Union Pacific, I bought Salesforce, ticker symbol CRM. This is a technology company. It is one of the biggest technology companies in the world, and it's incredibly powerful. I've owned this one previously in a smaller portfolio for a time, but this is the first time that I've introduced it into the passive income portfolio. And I want to go over my reason for buying this company over many other great options. I think the most helpful thing starting off for people that aren't really familiar with Salesforce is understanding what the business is and what it actually does. Now, I have a bit of an advantage here because I actually worked with Salesforce directly on multiple cloud integrations, on sales apps, and in different parts of their company, because I worked as a developer for a number of years, and many of the companies that I worked for and worked with were companies that use Salesforce. So I know this company both from a technological standpoint, but also from a consumer standpoint. I've done a lot of different backend integrations and different things with their API. So when I look at Salesforce, I'm more familiar with the company, but still not fully familiar with it because it is a vast, massive tech company with many different products, of which some of them I have not used. But when I look over at their suite of software, I find it as one of the most strikingly impressive tech companies in existence today. Let's go ahead and just go through some of the different segments here. We can look at Sales Cloud. This is like the customer page where you can read a description about what the Sales Cloud is. But on a more realistic view, Sales Cloud is like the original use case of Salesforce as a CRM. It's aimed at automating all different aspects of your business, from leads, customers, orchestrating billing. Common use cases include monitoring leads, forecasting, relationship intelligence, and so on. So if you use Sales Cloud, that is the original part of Salesforce. That is what they originally did 20 years ago when they first were a CRM for running the core components of a business. You can see here in the nice little image, this has everything to do with tracking your customer. Quotes with customer, pipelines, contacts, your invoices, all of that type of stuff is in the Sales Cloud. Now, Sales Cloud, again, at one point in time was Salesforce. This was 100% of the revenue. But like many of these companies do over time, they build new products and services. So right now, again, it's only 25% of their revenue. The next segment, which is around another quarter of their revenue, around 25, 26%, is the Service Cloud. The Service Cloud is like the communication center of Salesforce. It uses the same customer database that you have with the Sales Cloud, but this is like a whole suite of communication software with your customer. So think about things like customer engagement, different AI chatbots, different customer service bots, different call center capabilities. All of that is in the Service Cloud of Salesforce. So as businesses get on Salesforce and they start tracking their customers through the different sales flow, they want to have communication with those customers over time. Well, in most cases, it's easier for that company to use the built-in tools from Salesforce to track those customers than third-party products. Here's a video from Salesforce going over this.
Consolidate all your service tools and customer data in one easy-to-use console so service teams can take action faster, help agents be more productive and successful using omni-channel routing to connect customers to an agent with the right skills at the right time. And now with generative AI, boost productivity by automating tasks like creating summaries or new knowledge articles. Frontline teams have everything they need to get the job done with the mobile app, which you can customize with AI-powered workflows and out-of-the-box integrations to do more with less.
They give you some of the very basics here, but it's understating the capabilities of their Service Cloud. They have every type of automation, customer contact, and engagement tool you could possibly dream of in the Service Cloud. So obviously the Service Cloud has been an integral part of Salesforce's growth over time. The next segment of Salesforce is called the Marketing and Commerce segment, which makes up around 16% of revenue. And like you'd imagine, this has many of the online e-commerce marketing type of tools. things like email marketing, things like MailChimp, right? You have Intuit that owns MailChimp. Well, you have Salesforce building very similar tools for their customers. They try to target companies that are already at bigger scale for most of their marketing tools, but they have a ton of automated online marketing tools. They even have a competitor to Shopify. Since you already know your customers because you're using Sales Cloud, and you have the Service Cloud, which gives you all of the communication history of your customers, you can build the marketing and e-commerce tools already integrated with all of that data. So Salesforce links all of that together, making it so that they have a better competitive advantage than many other third-party companies trying to compete with this segment of their business. So even though they're competing with different companies in their Commerce Cloud, companies that already use Salesforce may decide to use them because of the data they already have about these customers. So you can think of the Commerce Cloud as competing with MailChimp, competing with Shopify, competing with Wix, and competing with any type of automated marketing tool. That's what they're competing with, but they have that inherent data advantage of the customer already being on Salesforce, and this is just another integration for them. The next segment of Salesforce is called the Platform and Other. And this is focused on the part of Salesforce where they sell different tools to help you develop on Salesforce. So you can basically build any type of custom tool you want through their API, or you can download different apps that are already pre-built solutions for different various integrations that Salesforce has not done themselves. This is very similar to the Apple App Store. So Salesforce has this big app store that all these third-party companies build upon, and then Salesforce charges developers $1,000 a year plus 15% of revenue. So the revenue sharing program here is actually much cheaper than Apple's because Apple starts out at 30%. So Salesforce charging 15% has strategically been better for the company. They've been under a lot less scrutiny because they have a much cheaper revenue sharing model. But regardless, this has been a flourishing and growing part of Salesforce. So many third-party companies build applications on Salesforce and they build their business on this app exchange in very similar fashion to so many third-party businesses building upon Apple's App Store. Because businesses know that Salesforce has a lot of support for developers, many businesses will use them as a CRM over third-party alternatives that don't have as many developers on their App Store. It's the same type of reason why the Fire Phone and the Windows Phone didn't catch on. They did not have enough third-party developers building software in their app stores, so customers didn't want to go with them, which created that reverse network effect. In Salesforce, you have the most powerful business app exchange in existence. Other companies building applications on their software, driving more network effects for customers to use them over competitors. Now, this segment does have other parts of it besides just the app exchange. So the app exchange is one part of the platform and other revenue. There's a whole other part of different developers building upon Salesforce using custom tools and integrations with Salesforce. You can imagine it in similar fashion to developers building upon Amazon's AWS. There's so many different tools to help integrate with AWS, and there's even consultants and different things AWS will do to help you integrate. Well, Salesforce operates in similar fashion. Now, finally, we get to the last segment, which is the data portion of Salesforce, making up 15% of revenue and growing rather quickly. This is like the data lake version of the company, where they harvest all the data that you have for all of your customers and massage it and make it useful for your company. We can watch a few seconds of their marketing here where they outline some of the basics.
Companies have more data than ever before, but that data is often trapped and disconnected from the business applications, like CRM, that are used to connect with customers. Unlike other data solutions, Data Cloud does more than just unify your data. It makes data from any source quickly accessible and easily actionable by service agents, sales reps, marketers, and merchandisers, because it's native to the Salesforce platform. When you bring data into Data Cloud, you harmonize it with Salesforce's broader metadata-driven platform. This data can be from inside Salesforce or an external data lake or warehouse, and is possible through zero ETL data access with partners like Snowflake, Amazon, Google, and Databricks, as well as hundreds of connectors available through MuleSoft.
They named off some of the big connections there. You have all the big tech companies, all the public clouds that you can connect with, companies like Salesforce. They also have the companies that they own. MuleSoft, Tableau, Slack, all these companies that they've acquired, they have all that data as well that, again, they can use for your benefit. So this is also a growing data company that's already making real money from data. So after looking at the different revenue segments, we just scratched the surface. Obviously, all of these different segments have a ton of different aspects to them that we could dive in for hours and hours. But just to go go over some of the basics here. I view Salesforce, obviously, as a very diversified, incredibly strong technology company. In fact, I believe that Salesforce is more comparable to another mature company that I really like. That's Microsoft. Microsoft is far more mature. It's a lot more optimized. The company's more profitable and I think more streamlined. But Microsoft is like Salesforce's older brother. It's a company that's just done a little bit more because it's been around a bit longer and has gotten to that more mature phase. I see Salesforce along that curve. It's a mature tech company, but not nearly as mature as Microsoft and not at the same point of optimization, margins, and overall just maturity. And that's why I sometimes refer to Salesforce as mini Microsoft. In my opinion, Salesforce is a company that has a powerful suite of software that's rivaling even the likes of a company like Microsoft. Their data and their strategy is more forward-looking and faster growing than the likes of Oracle, and their positioning is incredibly strong in this market. I believe they have long-term secular trends that will push this company further and further. Now, of course, that's a great story, Salesforce being mini Microsoft and having secular trends, but the company isn't flawless, and there's some things that I've historically criticized about this company that I think have changed over the past year. Let's go ahead and take a look. If I review my compounding machine checklist and the type of attributes I view as attractive and unattractive, Salesforce always had many of the attractive attributes. I view its huge software franchise as a bit of a monopoly. They're not an illegal monopoly. They do face competition. There are alternatives, but like many companies of their market share and their stature and power, they're incredibly difficult to compete with. There's extremely high barriers of entry. They also have strong pricing power, consistent with their long-term pricing of the company. We'll get to operating leverage here in a minute. That's something that's changed a lot over the past year. But the big one I want to focus on is organic growth. This is a company that historically has been known to do very expensive acquisitions. The most recent one they did was in 2020. They purchased Slack for $27.7 billion in a mega deal. And investors didn't really like this. They didn't like the fact that Salesforce was doing these incredibly expensive acquisitions, arguably at an overpriced range. This deal was expensive, and I would argue a bit overpriced. So in terms of organic growth, Salesforce has historically grown both organically and through major acquisitions. And this is something that I looked at very negatively over the past couple of years. But over time, Salesforce has matured a little bit and they are slowing down on their acquisitions. Management has said they're no longer doing expensive acquisitions. They don't have any in their line of sight. So I believe on a going forward basis, Salesforce will have more organic growth and less big acquisitions. The next big issue I've had with Salesforce is for each company, I'm looking for smart capital allocation. Companies that spend excess cash on buybacks, on dividends, and on tuck-in acquisitions, which are small acquisitions, not large, expensive, value-destructive acquisitions. Salesforce was not doing buybacks a year ago. They weren't doing dividends a year ago, and they've changed their policy on both of those. 1 month ago, Salesforce announced that they're doing a new dividend. For the first time ever, this company is now a dividend payer. So they are doing a quarterly dividend. It's presumably going to be raised over time every single year. And they also announced a $10 billion buyback program. So in the same quarter, just a month ago, you had a new dividend and a $10 billion buyback program announced. This is a major shift in their capital allocation strategy. They're shifting away from expensive acquisitions now to directly returning their excess cash back to shareholders. And this is what I love to see, companies that do buybacks and dividends at the same time. Almost every company in my portfolio does a buyback and a dividend at the same time, increasing the earnings per share and the free cash flow per share and returning money directly back to me. So I love the direction things are going with Salesforce, and I've seen a huge improvement over the past year alone in the direction the company's changing and in the leadership. Another thing that I've outlined with Salesforce in the past are undisciplined use of cash flow. The CEO of the company is a bit of an oddball, and he's done things like extravagant work parties. He's actually hired celebrities like Matthew McConaughey, $10 million per year to be their spokesperson, be an advertising tool for them. But he's also been known to have celebrities around, and I felt at one point that the CEO was just being careless with the company's cash flows. But he seems to have had a change of heart. Part of that was the pressure from multiple third-party activist investors jumping into the stock and pressuring him to be more disciplined with the cash flows. They informed him that the times have changed. We're no longer in a low interest rate environment. It's time to generate real cash flows, increase margins, and cut down on costs. And that is what he did. And for all the criticism that I've given Mark Benioff, I also have to give him compliments. Because the very things that I criticized him for a year ago, he has dramatically changed for the better. He has, on a dime, pivoted for the better. For example, let's look at some of the metrics here, specifically the ratios of the company and their operating margins. If we zoom in over the past 10 years, you can see the dramatic shift from fiscal year 2022 to 2023. Salesforce reports their year 1 year ahead, but fiscal year 2022, they had 9% operating margins. That was abysmal. Now, I thought there would be an improvement, maybe 12%, 13%. They bumped that up to 17% in a single year, most of it happening in a single quarter, showing that Mark Benioff was very, very serious about pushing profitability. To give some perspective here, we can look at this illustrated in the cash flows of the company. Again, the year that they account for is 1 year ahead. So it says 2023 here, but this is the calendar year 2022. So we look at 2022 here, and they had $6.31 billion in free cash flow. They bumped that up to $9.5 billion the very next year. That is an increase of 50% in free cash flow from 1 year to the next. We can look at the stock-based comp. This has historically, again, been a big criticism of mine for many tech companies, including Salesforce's. Up until 2022, Salesforce had around 50% of their free cash flow be stock-based comp, which means when you factor in the total cost of paying employees, their free cash flow is basically cut in half. But as you can see, over the past 12 months, not only has their free cash flow jumped by 50%, the stock-based comp didn't increase at all. In fact, it went down 15%. So in 1 year, we had a 50% increase in free cash flow and a 15% decrease in stock-based comp. When we look at the effects this had on the free cash flow per share, that means year over year, their free cash flow per share grew 53%. Now, I target a range of 15% per year. That's what I'm looking for in my companies. So obviously 53% is way above normal. I don't expect them to repeat this level of growth in the future, but it shows the amount of operating leverage in this business model. They really proved it over the past year. When we look at the expenses of the company, you notice the expenses growing in line year after year for an entire decade, in fact, 2 decades. But then the very last year, from 2022 to 2023, the expenses overall went down, especially their enormous sales and marketing costs. That was, again, something that investors looked at as negative. They looked at Salesforce as spending a lot of money on sales and marketing, but they went through and restructured. They focused on their cost structure of the company. They reduced a lot of unnecessary expenses. Salesforce is on track of reducing expenses year over year while growing revenue. So again, I've been critical of Mark Benioff before because at one point he was being careless with expenses, but he's certainly someone that's adaptable. He got the message. He listened to investors and their concerns, and he pivoted dramatically in the course of a few quarters, pushing out record profitability for the company. And it gives me the impression that he can do this at basically any time. Salesforce inherently has a lot of operating leverage. It's such at massive scale now that it will continue to grow organically even if they trim down on their expenses in their company. So I see this as an ongoing story. We have the story of continued revenue growth over time while you have less and less operating expenses of the company. In fact, Salesforce said in their last earnings call that stock-based compensation will never go above 8% of revenues. So they've given it a cap. They've said it's not going to go above 8% of revenues, and investors can take solace in that. They know that they're not going to be crazy with stock-based comp. We already have a limiting factor to it. So we know there's going to be more operating leverage in the company. So again, when I was looking at Salesforce and comparing it with the company I sold, Union Pacific, I looked at the overall growth profile of Salesforce and I find it more attractive. The company's growing its top line revenue around 10.5% to 11% per year, and that will continue on for years and years and years. Union Pacific had no growth for a decade, and it's growing slower than the rate of inflation. I also look at the margin expansion story. Salesforce will have a story of continued operating margin expansion over the next 10 years. It's not going to tap out at 17%. This will go on to 20% and 25%, and it will continue upwards over time. So I like the overall fundamental story of this company. We have revenue growth, we have margins expanding, we have free cash flow growing far above 15% for the next 5 years, and we have them doing a small dividend while also doing aggressive buybacks. So when I look over both the qualities of the company, the revenue segments, their secular trends, and the fundamentals, the direction they're going overall with the financials, I see a very resilient, growing company that will have continued increase in margins over time and continued profitability. Now, of course, we can't just go based on the fundamentals. We also have to look at valuation. I don't want to buy Salesforce at an extremely high valuation. And that's always a concern when you're buying leading tech platforms. Are you overpaying for the company? Let's take a look at some data here. If we bring up Salesforce again and we look at the stock price, I can zoom in over the past 5 years, and this shows a bit of a concerning line here. Salesforce in 2021 went up to around $300 per share. And right now, it's around $300 per share. So the company is around its all-time highs, which is a point that investors never want to buy a company at. They always get a little bit spooked when the company goes to all-time highs. Now, in my case, I don't mind buying Salesforce at all-time highs, and that's because I still believe that the valuation of the company is attractive. When Salesforce first hit its peak in 2021, they did $4 billion of free cash flow. In 2023, Salesforce did $9 billion in free cash flow. So even though the company is trading at the same price it was back in 2021, the free cash flow has over doubled. The free cash flow per share has about tripled since then. So the company's intrinsic value has grown dramatically over that time period. And with continued intrinsic value growth, eventually the stock price will follow. I believe that as Salesforce continues to grow its intrinsic value, the company's price will reach all new highs. Now, Salesforce trades at a 31 PE ratio, a 3.2% free cash flow yield. Adjusting for stock-based comp, it's around a 2.3. But that doesn't give us much context into what to expect for the future of this company. So I've outlined my base case for Salesforce, what I believe will happen. And I've done so using the scenarios tool in Qualtrim. This is a tool that's still in beta. We have some finishing touches we're making, but this does give us an expectation of the future because we can run discounted cash flows and do different scenarios based on the stock. I assume 10% revenue growth for the next 5 years. I assume that at the end of the next 5 years, it will have EBITDA to revenue margins of 43%. This is still lower than Microsoft, so I'm still assuming lower margins than Microsoft today at the end of 5 years, which gives Salesforce plenty of time for margin expansion. I assume that their capital efficiency, their CapEx to revenue, will be around 2%. That's right around where it is today, so not much change there. And then I give Salesforce medium predictability. I could give this one high predictability because I think it is a very predictable company, but just to be very conservative, I'm going to give it medium predictability. When I look at the financials on a 5-year projection, I believe that the cash flows next year will be around $12 billion. So that's what my assumption is with the 10% revenue growth, with the margins expanding over time. In 2025, which again is fiscal 2024, so this is technically this year, it's going to be $12 billion in free cash flow. Why am I assuming that? Because that's exactly what management guided for. Management of Salesforce said that cash flows would grow around 25% year over year this year. 9.5 plus 25% is around $11.8 billion in free cash flow. Now, I continue to believe Salesforce will have a compound annual growth rate in free cash flow around 19% per year for the next 5 years. That is the compound annual growth rate, but it will start off quicker at around 25%, and then it will rapidly decline over the next 5 years. That gives us to a cash flow in 2028 of $21.36 billion. We can make some assumptions based off of those cash flows. Let's assume that's the case. Let's assume Salesforce has that $21 billion 5 years from now. What will the returns be based on the yield it trades at in 5 years? Well, I can look at that illustrated here. If Salesforce continues to trade at the very same yield it does today, so the valuation has no change at all, then returns will be compounded 15.8% per year. So you're getting around a 16% return annualized for the next 5 years with no valuation change whatsoever. Now, if the valuation goes down, meaning the free cash flow yield goes up, the returns per year go down. If it trades at a 4% yield in 5 years, we have a 12% return. If it trades at a 4.5, we have a 10%, and so on. And of course, we have the inverse. If Salesforce, for whatever reason, gets more expensive, we have even better returns, 20% returns over the next 5 years if it trades up to a 3% free cash flow yield. If it trades up to a 2.5%, that's a 25% return. But I believe the company intrinsically should trade around 3.5 to 4% free cash flow yield. So I believe the returns will be around 15% to around 12%, somewhere in that range. And I think that's a very healthy return expectation for this company. So obviously, with the return expectation of around 15% per year based on my own projections and their financials, I think Salesforce offers still a lot of upside and continued returns going forward. It's hard to say that after the company's up 17% year to date, it's so difficult to buy into companies that have already gone up. Our human brains hate it. We don't want to buy companies after they've already appreciated. But this is something called anchoring bias. And anchoring bias is terrible for human investors. It's the reason why ETFs and index funds outperform humans. ETFs don't have anchoring bias. Indexes don't look at historical prices and say, oh, I wish I could have bought here. That would have been better. I don't want to buy here. No, ETFs are perfectly logical. ETFs do not base their buys on emotions of anchoring bias or loss aversion or sunken cost. I'm buying Salesforce today because I think going forward, it is a better position in my portfolio than Union Pacific. I believe it will have higher expected returns. I may be incorrect. There are still many risks with this stock through competition or management reverting to their old ways, but it's a risk I'm willing to take. But that's my thoughts overall on this trade. Let me know what you think about this. Am I making a big mistake? Do you think I'm going to lose money on Salesforce? Is it a bad buy? I'd like to hear your opinion either way. Now, moving on, I've had a lot of requests to do some TikTok reviews, to look at what's going on in the financial sphere of TikTok and get my reaction on it. This is a TikTok from this girl here about some car payments she has. So let's go ahead and listen to this.
Do y'all want to know what is worse than my Tahoe payment? You guys thought that was bad. Wait till you hear this one. It's my husband's truck. My husband drives a 2020 GMC AT4 Sierra 1500. We bought it in August of 2022. Financed it for $78,000.
$78,000 is such a high number that there's not a single position I've ever bought where I've personally invested that much money into the position. I've had some grow above that through capital appreciation, but that is more than I've ever invested in any stock, including the likes of Apple or Costco or Texas Roadhouse or any of those. So all that money that you could be using, building wealth, making investments, is being thrown into financing a vehicle.
His payments are $1,600 a month.
So this $78,000 truck is costing him $1,600 a month in payments. The majority of that is going to interest. So the bank is giving him a big fat loan. He's paying the bank a bunch of money to drive around a truck that he doesn't really own. I want to just highlight a couple things here about me personally and my financial history. The first thing is that the most expensive vehicle I've ever purchased my entire life is a $26,000 family van. That was it. A new family van is a cheaper one, but it does a job. It's actually pretty nice. We got a good deal on it but right before COVID was happening. So I guess we got a decent deal on it. It would normally be like $30,000, but we paid $26,000. Our monthly payment on it is like $400. So we're paying $400 a month on it, and our interest rate is 2.2%. Because I could pay it off right now, but my savings account is earning over double the interest of my car payment. But regardless of that, the total cost was $26,000 for our most expensive vehicle ever. Outside of that, most vehicles we've driven have been used. We bought them for anywhere around $15,000 to $24,000. You can get nice Subarus and Hondas for that price, reliable vehicles. The idea that you have to spend $78,000 on a vehicle is totally unnecessary. This is an entire industry, the car industry, that is ripping people off, making people incredibly poor. They are having money sucked out of their household every single month to a bank because they've been convinced that they need an expensive truck that they don't. And this is damaging people's financial futures, damaging their comfort, damaging their ability to pay for unexpected expenses and upgrade their lifestyle. I see expensive vehicles, especially expensive trucks, as one of the biggest waste of money possible in our modern day. I think it's worse than almost every other expense, but we continue on.
So y'all thought my $1,400 Tahoe payment was bad.
You have vehicles equivalent to $3,000 per month just to pay them off. These people are like the Joker, just lighting money on fire. I get different people have different relationships, but if you are combining your household income, you may as well combine your payments. You both are spending over $3,000 per month on your payments.
With an APR of 14%.
When you keep thinking this can't get any worse, she just keeps adding in these little bits of data that make it far worse.
Or maybe we should just let them both go back because we have the Audi now and don't need either of the car payments.
When you have horrible credit, you're working a day job to pay off interest on vehicles you can't afford. The next thing to go to is to buy a higher end brand like Audi. The right thing to do here is to sell all of these vehicles and buy a beat up Honda Civic and use that until you have everything paid off, trying to restore credit over time. But I have a feeling that's not what she's going to do. This TikTok is another illustration of how many people are struggling financially that don't need to be. They're hardworking, they earn money, but they're making a few really poor decisions that lead to financial destruction. And instead of living a very stress-free life where finances aren't a big issue, instead they get caught in an endless destructive cycle of never being ahead financially and always paying interest payments on high interest debt that they don't need to have. So if you know anyone in your life that is deciding whether or not to buy a new expensive car, and you look at their finances and know that it's going to be a stretch, strongly encourage them not to. Talk them out of it. Do everything you can to influence people to make better financial decisions. But that's going to be it for this time. I hope you enjoyed, and I'll see you in the next one.